Bitcoin is not crashing in isolation. It is being dragged down by the exact same force crushing software stocks, stressing private equity, and draining liquidity out of risk assets across Wall Street. That is what happened. This is not a normal crypto pullback. This is not a healthy reset. This is a cross-market liquidation event. And if you still think Bitcoin is trading on its own story, you are looking at the wrong screen. What is breaking Bitcoin right now is breaking the market's faith in software valuations, in private credit, and in the entire idea that high-growth assets can keep levitating while the ground underneath them is moving. And if that connection is real, the next move in Bitcoin is not just about crypto. It is about the entire risk complex. In the next few minutes, I'm going to show you why Bitcoin and software stocks are suddenly moving like they are tied together by a rope, why private equity is making this even more dangerous, and why this sell-off could either become one of the biggest buying opportunities in recent memory or the first stage of something much uglier. Because once you see the mechanism, the chart starts making sense. And right now, that mechanism is ruthless. Let's start with the break itself. Bitcoin had been trading in a range for weeks. It was unstable, but it was still holding together. Traders were telling themselves the same story they always tell in a shaky market: consolidation, shakeout, preparation for the next leg up. Then the floor gave way. Not all at once, not in a single clean candle, but in the way real market damage usually happens. Weak bounces, failed recoveries, sellers showing up harder every time price tried to stand up. By the time US markets opened, the rebound attempt was already dying, and when equities started trading, Bitcoin rolled over again. That detail matters, because the collapse did not intensify in a vacuum. It intensified when Wall Street came online. That tells you immediately this was not just a crypto-native event. This was not only leverage getting washed out in digital assets. This was macro risk hitting crypto through another channel. The problem was already inside the traditional market, and once cash equities opened, Bitcoin started trading like a tech asset with a higher beta, not like an independent monetary alternative. Now here is where most people get the story wrong. They look at Bitcoin first because Bitcoin is dramatic. It is fast. It bleeds in public. It gives you the spectacle. But the deeper fracture started in software, specifically in the part of the market investors had spent years treating like the cleanest expression of growth. Large, established, cash-generating software businesses. The kind of companies institutions thought were safe enough to pay premium multiples for because their revenues looked recurring, their margins looked strong, and their business models looked embedded into the modern economy. That confidence is now being repriced brutally. Software stocks have been sliding for months, and not in the casual way that markets rotate from one sector into another. This has been a hard, persistent unwind. Fresh lows, failed rallies, buyers stepping back, sellers pressing every bounce. And the reason sitting behind that unwind is as simple as it is destabilizing. The market is terrified that generative AI is not just another feature upgrade. It may be a margin crusher, a pricing destroyer, a product substitute, a force that can compress the value of traditional software faster than the market had ever modeled. Think about the psychology of that for a second. For years, software was sold to investors as one of the cleanest games in the market: high margins, predictable revenue, scalable growth, low marginal cost, defensible moats. Now inject a new technology that threatens to answer the most dangerous question any investor can ask. What if customers do not need to pay the same price for the same function anymore? What if the product itself is not obsolete overnight, but the economics around it are? What if the moat is real, but much narrower than people thought? That fear alone is enough to crush multiples, and markets do not wait for the obituary before they start repricing the funeral. And this is where Bitcoin enters the same storm. Because Bitcoin is no longer being treated like digital gold in this environment. It is being treated like an extension of speculative tech, a high volatility expression of risk appetite, an asset that performs when liquidity is loose, when growth narratives are expanding, when investors are comfortable stretching for upside. The moment software started trading like a sector under existential pressure, Bitcoin stopped being a separate story and started amplifying the same move. That is why the correlation looks so disturbing right now. Software down, Bitcoin down. Software bounces, Bitcoin bounces. Software breaks lower, Bitcoin follows. Not eventually, not loosely, almost in sync. The market is telling you, very clearly, that it has shifted Bitcoin into the same basket as high beta growth risk. And when that basket gets liquidated, Bitcoin does not hide from the move, it exaggerates it. This is one of the most important shifts happening right now, Because it destroys a comforting narrative a lot of people still want to believe. The narrative that Bitcoin will automatically decouple when traditional markets get messy. Maybe one day it does. Maybe in another regime it can. But in this regime, in this tape, in this moment, the market is not rewarding theory. It is rewarding liquidity, caution, and survival. And Bitcoin, for now, is on the wrong side of that trade. But even that is not the full story. Because layered on top of software stress and Bitcoin correlation is a third pressure point. And this is the one that has the potential to turn a violent sell-off into a true systemic scare. Private equity. This matters because private equity spent years swimming in the exact pond that is now being poisoned. Software deals, growth deals, borrowed money chasing businesses whose value depended on high multiples, steady demand, and confidence in future cash flows. When rates were low and the growth story was clean, the model looked brilliant. Buy, lever, scale, refinance, exit. Everybody wins. Now imagine that same model in a world where software multiples are collapsing, AI disruption is clouding revenue visibility, credit is tighter, and investors want liquidity back. Suddenly those portfolio companies do not look like crown jewels. They look like illiquid positions marked against a public market that is falling apart. And when investors in these funds start demanding cash, firms have two terrible choices: sell assets into weakness, or find some other way to raise liquidity while confidence deteriorates. Neither is good. Both send signals. And the signal the market hears is simple: the smartest money in the room may not actually be calm. That is why the declines in major alternative asset managers matter so much. These are not meme stocks. These are not tourists panic selling. These are institutions that sit near the center of modern capital flows. When they come under visible pressure, investors start asking bigger questions. How much leverage is sitting under the surface? How many software-linked assets are marked at values that no longer make sense? How many loans were made on assumptions that are now unstable? How many investors are going to want out if this keeps getting worse? And once those questions show up, the comparison everyone tries to avoid starts floating into the room. 2008. Not because the assets are identical, they are not. Not because the structure is identical, it is not. But because the logic rhymes in a way that should make you uncomfortable. In 2008, the system was full of confidence built on an asset class people thought was safe enough, broad enough, and liquid enough to support layers of leverage. Housing held up that illusion until it didn't. Then the loans tied to it started looking toxic. The securities built on top of it started breaking, and the damage spread far beyond the original market. Now replace housing with software exposure. Replace mortgage optimism with years of belief in infinite software demand and premium valuations. Replace one kind of leverage with another. Replace one supposedly safe growth engine with another. Then ask the only question that matters. What happens if the market starts deciding that a giant pile of software-related assets was priced on assumptions that no longer hold? What happens if the borrowers, the lenders, the fund investors, and the exit markets all realize that at roughly the same time? You do not need a perfect repeat of 2008 for that to be dangerous. You just need enough credit stress to change behavior, enough forced selling to hammer valuations, enough redemption pressure to turn patient capital into impatient capital, enough fear to make liquidity disappear from the places that looked deep until everyone tried to use the door at once. That is how a sector problem turns into a market problem. Now add politics to the mess. Trade policy uncertainty, tariff confusion, businesses delaying spending because they do not know what the rules will be. That matters because software demand is not immune to macro hesitation. When companies get nervous, they slow hiring, cut budgets, defer projects, renegotiate contracts, and question every expense line item. In a market already asking whether AI is going to compress software economics, uncertainty around growth and trade makes the situation even worse. It is another layer of hesitation poured onto a sector that was already bleeding confidence. And when you combine software fear, private equity stress, macro uncertainty, and falling risk appetite, you get the exact environment professionals call risk off. That phrase sounds clean, almost harmless. It is not. Risk off means investors stop asking how much upside an asset has and start asking how quickly they can get out if conditions deteriorate. It means correlations rise. It means diversification starts failing. It means things that are supposed to be separate suddenly move together because the market is no longer pricing stories. It is pricing exit behavior. That is exactly what Bitcoin is trapped inside right now. It is not being judged only on its long-term fixed supply narrative. It is being judged on how it behaves when portfolios are de-risking, when software is under attack, when private credit looks shaky, and when managers need liquidity more than they need conviction. In that environment, Bitcoin stops looking like protection and starts looking like exposure. Now let's be precise. This does not automatically mean Bitcoin is finished. It does not mean the long-term thesis is dead. It does not mean support cannot hold. In fact, one of the most important details in this entire story is that despite all the fear, Bitcoin has still been finding buyers in a major range. That matters, because even in a risk-off environment, there are still participants willing to step in. Long-term holders, institutions, funds, people who understand that violent sell-offs in Bitcoin are not new, and that some of the best entries in its history looked absolutely horrifying in real time. But support only matters until it fails. And that is the line the market is staring at right now. If Bitcoin can keep holding key levels while software stress stabilizes, the entire move can start to look like a brutal but temporary repricing. The kind of sell-off that creates panic at the bottom, an opportunity for anyone patient enough to think beyond the week. But if support breaks while software keeps bleeding and private equity keeps wobbling, the next leg lower could come fast. Because once the market decides a range is no longer a floor, it starts hunting for the next zone where real buyers are willing to absorb pain. So what comes next? There are really two main paths, and both matter because pretending only one exists is how investors get blindsided. The bullish path is straightforward, even if it feels impossible in the middle of fear. The market may be overestimating how quickly AI can replace or impair the software sector. Many software companies still have massive distribution, sticky workflows, entrenched contracts, and customer relationships that do not disappear because a new model showed up. Some may adapt faster than people expect. Some may integrate AI and come out stronger. If earnings start proving that the extinction narrative is overdone, software can stabilize. If software stabilizes, one of the biggest weights on Bitcoin starts to lift. Then there is the macro angle. If economic weakness deepens and policymakers start leaning dovish, lower rates or even the expectation of easier policy can bring oxygen back into risk assets. And when liquidity expectations improve, Bitcoin usually reacts violently. It does not move like a slow blue-chip stock. It snaps. It reprices fast. It punishes anyone who waited too long for perfect clarity. That is the nature of high-beta assets. They break hard when fear hits, and they rip hard when the market senses the pressure is easing. And of course, there is the simplest bullish argument of all. Bitcoin has been declared dead more times than almost any asset in modern finance. Then it comes back. Different catalyst. Same obituary. Same mistake. The network keeps running. The supply structure does not change. The long-term believers do not vanish because one cross-market unwind got ugly. If you believe the larger adoption and scarcity story still matters, then panic in a correlation regime may still be just that. Panic in a regime, not the end of the asset. But the bearish path is real too, and ignoring it would be stupidity dressed up as conviction. If software weakness becomes a broader credit event, if private equity starts seeing more serious liquidity pressure, if capital markets freeze up around highly valued growth exposure, then Bitcoin probably does not get a free pass. In a real credit scare, people sell what they can, not only what they want to. That distinction matters. In forced liquidation, good stories and bad stories can go down together because the immediate need is cash, not elegance. We have seen versions of this before. When markets truly panic, even assets with strong long-term narratives can get smashed because investors are not optimizing for 5 years out. They are surviving the next 5 days. If that dynamic takes hold, Bitcoin could see levels that sound ridiculous today and obvious in hindsight if the floor disappears underneath the whole risk complex. That is why risk management matters so much here. Not because risk management is exciting, it isn't, but because survival is what gives you the right to benefit from the next opportunity. First, know what you can actually tahammel before the market forces you to find out. If another sharp leg down would make you panic sell, your position is too big. Figure that out now, not during the next red candle. Second, liquidity is not laziness in an environment like this. Cash is optionality. Cash lets you act while others react. Third, stop lying to yourself about diversification if everything you own is secretly tied to the same risk regime. Stocks, crypto, software ETFs, private market exposure. If they all break together, That is not diversification. That is concentration wearing makeup. And most importantly, zoom out without switching your brain off. Zooming out does not mean ignoring danger. It means refusing to let temporary violence make permanent decisions for you. Some people will sell the low because they cannot handle the pain. Some will blindly average down into a real breakdown because they confuse stubbornness with discipline. The right move is not emotional. It is planned. It is sized correctly. It is flexible. It respects both the bull case and the bear case without worshiping either one. So here is where we are. Bitcoin is no longer trading like an isolated rebel asset. It is trading like a levered expression of the same fear, crushing software and spreading through private equity. That is the story. That is why the correlation matters. That is why this move is bigger than crypto. If software finds a floor and credit fears cool, Bitcoin can recover sharply. If software keeps collapsing and private equity stress spreads, Bitcoin could get dragged much lower before the market is done de-risking. The line in the sand is not just a price level. It is a question. Is this a violent reset inside a long-term bull structure, or the first phase of a deeper unwind across speculative growth assets? That is the real fight now. Not the headlines, not the noise. That question. And now I want your view. Do you think Bitcoin is still a buy here, or is this just the start of a much bigger unwind? And which breaks first, the software panic or the support under Bitcoin? Subscribe if you want the next breakdown before the crowd figures out what the chart is actually saying.